Hello, good morning, students.
Good morning, sir.
Good morning. Good morning. खोइ त हो तपाईँ जाडो लाग्यो क्या हो जाडो बिदा दिनुपर्ने बेला भइसक्यो त जाडो बिदा छैन भने खोइ त स्टुडेन्टहरू आउँदै आएन ओके लेट्स स्टार्ट only 15 students are joining. Okay, in the previous class we were discussing financial statement analysis and different tools of financial statement analysis. There we discuss meaning, objective or importance, and limitations of financial statement analysis. Now, techniques of financial statement analysis. There are different techniques used for the analysis of financial statements. Hello. Okay. And among these different financial statement and tools of financial statement analysis is vertical analysis or common size analysis. Under vertical analysis, the a percentage of each and every component of financial statements are calculated, assuming sales 100% in income statement and total assets 100% total assets in the balance sheet and so on. So portion of cost of goods sold in income statement, portion or percentage of cost of goods sold, percentage of gross profit, percentage of office expenses, selling expenses, then other incomes, other expenses, then profitability position is calculated, assuming 100% for sales. Similarly, in the income state balance sheet, total sales is assumed 100%, and out of total sales, how much is cash, how much is bank balance, how much is PPE, property, plant and equipment, and how much is intangibles, how much is investment, how much is other assets. And similarly in liabilities also, total liabilities and liability and equity are equal to the total asset. Therefore total liability and equity is assumed as 100%. Out of total liability and equity, how much is short term liability, how much is long term liability, what percentage is short term liability, what percentage is long term liability. In this way each and every component will be analyzed, keeping or assuming 100% to 100% to sales for the income statement and 100% to the total assets in the balance sheet. Then we'll discuss the practical example of vertical analysis also. Another is horizontal analysis. Under horizontal, it is also called trend analysis. And under horizontal analysis, the base year, first year is assumed as 100%. Then we calculate the total percentage of each and every component of income statement and balance sheet with respect to the base year or current year, and by what percentage it is changed we calculate it. It means in the income statement, sales is assumed as 100%, cost of goods sold is assumed as 100% of uh, first year of the study period, and similarly gross profit is assumed as 100%. Similarly office expenses, selling expenses, other income and profit, all the components of the income statements of the first year of the study period or first year of the establishment period is assumed as 100%. Then by what percentage it is, each and every component changed increase or decrease, that is calculated under the horizontal analysis, and that will be also discussed from the exercise also. And average analysis is analysis of the company's performance based on or with the industry average. So company's performance, profitability position, debt equity ratio, debt equity position, debt capital position, current ratio, liquidity position of the company are compared with the with the industry average or average of the similar company under average analysis. Another is statement of changes in working capital analysis or analysis of statement for changes in working capital. Changes in working capital, and working capital is the difference between total current assets and total current liabilities. Total current assets and current liabilities. So each and every period's working capital of each and every period is calculated and compared. Is it increase or decrease? And when huge amount of working capital managed by the company and it does not produce the income, so it is simply the stock of the current assets in the business, and that is not productive, and that does not generate the income. So it is also in increasing or decreasing trend that can be also analyzed comparing between two or more periods. Another is funds flow analysis and calculation of funds flow due to the change in the working capital, that will be analyzed, and fund flow statement you studied in plus 2 and bachelor level. So funds flow analysis is also used to identify and to analyze the funds flow due to the change in the working capital. Another is cash flow analysis, and you studied cash flow statement in plus 2 and bachelor level. And now here we focus on the analysis of cash flow. So after this chapter or in chapter 5, we'll discuss about the cash flow statement, preparation of cash flow statement and its analysis. And analysis of cash inflow and outflow from various activities by with activities, and analysis of cash flow with respect to sales, with respect to total assets, with respect to different other components, and ratio or comparison between cash flow from investing and operating activities, cash flow from investing and financing activities, and so on, that we will discuss in the cash flow analysis in next chapter. And next is cost volume profit analysis that you studied in the second semester. You studied their relationship of cost volume profit and PV ratio, profit volume ratio, its effects, change in the any component, fixed asset, fixed cost, change in the variable cost, or change in the selling price, change in the sales volume, and there will be the effect on the profit. That analysis is cost volume profit analysis. Beside this, you study their sensitivity analysis, that is the important part of cost volume profit analysis. And similarly, the effect of stock when there is closing stock, provision of closing stock, how much of the break even, how much is the break even. Similarly, how much is the sales volume required to maintain the minimum or desired amount of sales in case of stock under LIFO condition, under FIFO condition that you studied. And that's they all are the components used for analysis of the profit with respect to or showing the relationship of cost and volume. And the last is ratio analysis. And ratio analysis, according to our syllabus, we are going to focus the ratio analysis, and cash flow analysis will be discussed in next chapter. And cost volume profit profit analysis you studied in the bachelor as well as in second semester. And funds flow and statement working capital you already studied, and average analysis will be also studied here in ratio analysis, and vertical and common size analysis. Now, first we are going to discuss common size or vertical analysis. And I had already told you under vertical analysis sales is assumed as 100% in the income statement, and total assets are assumed as 100%. Then portion of different components like cost of goods sold, other expenses, percentage of cost of goods sold, other expenses are calculated on sales. Then that percentage of each and every components of income statement are compared to other companies of the current period, or are compared to past. Then increase decrease that will be analyzed. And similarly, in the balance sheet total asset is assumed 100%, and percentage of each of every component of assets and liabilities are calculated, and that percentage will be compared: percentage of cash, percentage of bank balance, percentage of stock, percentage of data, or percentage of PPE, percentage of intangible investment, etc. They are calculated based on total assets, or on total assets. Then these percentages are compared with the past, and these percentages are also compared with other competitors. Then companies' real positions are calculated. Here is one example. Then we go to the exercise regarding vertical analysis and horizontal analysis. Now you are given the income statement here. Suppose sales, cost of goods sold, and they are 5 lakh, and this is the income statement here prepared. And as per income statement, or we assume 100% for the income statement point. Then we calculate 5 lakh rupees is the okay. I had already told you sales is assumed as 100%. Sales is assumed as 100%. And uh, 5 lakh rupees sales is assumed 100% under the common size statement or vertical analysis. And 3 lakh rupees is cost of goods sold. What percentage is cost of goods sold on total sales? Total sales. 3 lakh rupees is the cost of goods sold, and 5 lakh rupees is the total sales. And what percentage is the total sales? What percentage is the cost of goods sold on sales? It is 3 lakh divided by 5 lakh. It is 60%. It is 60%. And similarly, 2 lakh rupees is gross profit. What percentage is 2 lakh rupees on 5 lakh, or on sales? 2 lakh divided by 5 lakh, it is 40%, or 100% minus 60%, it is 40%. Another is office and administrative expense. Office and administrative expense. It is 50,000. 50,000 divided by 5 lakh rupees. Or all the percentage of all these components of the income statement are calculated on sales. So when sales is 5 lakh rupees and 50,000 is office and administrative expenses, what percentage is office and administrative expense? It is 10%. 50,000 divided by 5 lakh. And similarly, what percentage is the selling and distribution expenses when it is 30,000 and sales amount is 5 lakh? What percentage is selling and distribution expense on sales? 30,000 divided by 5 lakh. It means 66%. It is 6%. Now other income. Other income. Uh, Other income is 10,000 rupees. And what percentage is other income on sales 5 lakh rupees? 10,000 divided by 5 lakh rupees. It is 2%. So you subtract here 40% minus 10% and minus 6%. It is 24%, or 1,20,000 divided by 5 lakh. It means percentage of operating income on sales, 1,20,000 divided by 5, you get 24%. or you deduct 40% minus 10% minus 6%. Similarly, other income, 10,000 is other income, sales is 5 lakh. 10,000 divided by 5 lakh. So what percentage is it? 2%. And add this, it is other income, add it is 26 percentage, or 1,30,000 is net profit before tax, and sales amount is 5 lakh. So what percentage is the net income on sales? So 1,30,000 divided by 5 lakh, it is 26%. Similarly, less income tax, and when income tax is 32,500, when the company has sales 5 lakh rupees. So what percentage is the income tax on sales? 32,500,
6.5%. 5%.
6.5 percentage. 32,500 divided by 5 lakh. And you subtract, income tax is subtracted, and it is 19.5%. So company has on 19.5 percentage of profit or net profit after tax on sales, or 97,500 divided by 5 lakh. In this way, we calculate the percentage of each and every components of a year. And similarly, second year, third year, or past periods, percentage of each and every components of income statements are calculated, assuming sales 100 for past periods. Then the profitability increase or decrease, office expense increase or decrease, that can be analyzed with the help of common size statement. So under common size in statement, uh, the sales is assumed as 100, and percentage of each and every components are calculated and analyzed with, or comparing with the past periods, or comparing with the competitors. Mm. This is the calculation of or analysis process of common size. And from the, in the balance sheet case, we'll discuss from the exercise. Then first we discuss horizontal analysis, then we do from the exercise. Now horizontal analysis is the analysis of financial statement over a series of the years. So I had already told you, base year is assumed as 100%. Each and every component of financial statements are assumed as 100%. Each and every component, not sales or not total assets here. Each and every component of financial statements are assumed as 100% for the first year of study period, or commencement period. Then what percentage is changed for each and every component of income statement or balance sheet under horizontal analysis for in different periods, that is calculated and analyzed. This is like this. Suppose sales is given for 2015 and 16, 17, 18, 19. Then sales of 2015 is assumed as 100%. Cost of goods sold of current year 2015 is assumed as 100%, and gross profit is also 100%. And office and administration and each and every component of financial statements are assumed as 100%. Then other percentage of other different periods for different headings are calculated, assuming 100% for each and every period, every component of 2015. So uh, after that, we'll discuss the ratio analysis. Now let's see from the exercise how vertical and horizontal analysis is made under um, analysis. Page number 151. Page number 151, question number 4.21. Now I am setting the Excel file. Now look at it. In page number 151, page number 151. Now question number 4.24. Comparative balance sheet and comparative income statement for 2073 and 74 are given. Now, required evaluate the company's performance using common size or vertical analysis. Now, you write down on the top common size statement analysis. You write down common size statement analysis. Comparative balance sheet, and we are given first balance sheet. So as on Chaitra 2031st and 2073, 2074, we write in the column. And particular 2073 and 2074 and percentage, we calculate the percentage of each and every component, assuming 100% for total assets. That means 100% is total liability and stockholders equity in the balance sheet. Similarly, in the income statement, so we assume 100% for sales, 100% for sales, sales of both of the periods. All of you first copy this, then we calculate percentage of each and every component. So you first copy the question. Right? Did you copy?
Sir, एकछिन बात छैन.
On the top, you write down common size statement analysis, comparative balance sheet as on 31st Chaitra. Then you calculate the percentage, assuming total assets 100%.
रेकर्ड गरौँ न
Finished?
सर
हजुर
क्लास रेकर्ड गरौँ न
ए बिर्सिएको नि अघि भन्नु पर्थ्यो यहाँ जाडो बिर्सिहालेछ ओके Finished? La. Calculate 6,50,000 is the total assets. What percentage is the current assets? If you are given here cash, bank, debtor, short term, and accrued, whatever, each and every component, percentage of each and every component you should calculate. But it is very long. Therefore, I have in this question, current assets is directly given, long-term investment given, property, plant, equipment directly given, plant, furniture, vehicle, land and building. If you are given separately, you should calculate the percent of each and every component separately. So what percentage it is? 2 lakh 2 lakh divide by 2 lakh divide by 6,50,000 6,50,000 multiply 100 it is 30.77 percentage. Round off to two decimal place, 30.77 percentage. Similarly, you calculate 1 lakh rupee percentage of long-term investment. 1 lakh rupees divided by 6,50,000. It is 15.38%, and 3 lakh divided by 6,50,000. It is 46.15%, and 50,000 divided by 6,50,000. It is 7.69%, and the sum is 100. And the sum is 100. Now, similarly, you calculate the percentage of current liabilities. I had already told you if you are given different components or different current liabilities, under current liability heading, and different long-term liabilities, bank loan, mortgage loan, debenture, bond, and you should calculate the percent of each and every components of liabilities heading also. And similarly, under stockholders equity, there are mainly preferred stock, common stock, and retained earnings. So we should calculate the percentage of each and every components there. So 80,000 80,000 divided by 6,50,000 multiply 100 multiply 100. So it is 12.31 percentage, and you calculate the percentage of each and every component like first current liabilities. Now similarly you calculate the percentage of each and every components assuming 100% for total assets in the 74. Then you can analyze the current assets increase or decrease, current liability increase, decrease. Amount is not important there. Then percentage makes the both years data at 100 in the same base 100. Then after we come, it is easier to compare out of 100 percentage increase or decrease, and is that better or worse, that can be explained and interpret. 12.31%, 30.77 percentage, 40.08 percentage, 43.08 percentage is the total percentage of liabilities. And similarly 56.92 percentage is the total of stockholders equity. Similarly you calculate for 2074, 3 lakh is the total current assets divided by 1,050,000 or 10,50,000 multiply 100 is 28.57. And similarly you calculate percentage for other. Take the sum, it should be 100%. Similarly total liability and equity is 1 lakh 10,50,000, and calculate the percentage of 1 lakh rupees divided by 1 lakh divided by 10,50,000, 10,50,000, 10,50,000 multiply 100 multiply 100. It is 9.52. Did you finish? Finished? Balance sheet.
ब्यालेन्स सिट चाहिँ सक्यो तलको चाहिँ सकेको
Now,
छैन
similarly, for 75, 76, we calculate this and then we analyze. Now, first listen in analysis part of balance sheet under common size statement analysis. Current asset is 30 percentage. So current asset is 30 percentage, and in the 74, 73 and 2074, it is 28.57. Now, position of current asset decrease. It is better or worse? Is it worse or better or worse? 30% is the current assets in the 2073. Now 28.57. Is it better or worse? What do you guess? Better or worse? It is better because current liability also decreased from 12 percentage to 9.52 percentage. Liability also decreased. So company as total current assets decrease, or percentage of current asset decrease from previous year to current year. Increasing the amount or increasing the portion of the current assets is unproductive because increasing the current asset does not produce the additional income. So companies should increase the amount in long-term assets, especially PPE, plant properties and equipment, which you have seen increase here. Look at here, plant assets is 46 percentage in 2073 and 57 percentage. It is increased by 11%. Therefore, company company can generate more income by investing its capital on the plant and properties or plant and equipment. And intangible value of intangible is decreased here 7.69 to 4.76 percentage. Therefore, companies in total amount is same, but in comparison to total assets, the percentage of portion of association of intangible assets in the company decreases. So company has focused to invest its capital on the purchasing of assets or investment on long-term plant properties and equipment, so that it will certainly generate the profit in the long run. So it is better. And decreasing in the current assets, current liabilities, and increasing in the current assets, so it shows better position. And similarly, earnings, 10% is the earning reserve and 14% reserve in the current year. In such condition, we can say the amount of profit company earned more profit and kept in reserve or retained earnings, and its retained earning can be used in the future. So the amount of percentage of retained earning increase. Similarly, company has also invested additional amount of capital, which is increased 30% to 47%. So increasing capital certainly supports to make the payment of long-term liabilities as well as investment in the business. And but preferred stock is decreased here. Percentage of preferred stock decrease. It means amount remain constant, no any amount redemption, but association of preferred stock on our total assets, our total liabilities and equity, it is decreased. But capital, percentage of capital, portion of capital increase, and amount is also increased, it is better. So each and every component you should explain based on the percentage and percentage of percentage, based on percentage rather than amount. Now next is common size statement analysis for comparative income statement for the year ended 31st Chaitra. Now you just simply you copy the questions for 73 and 74. Then after you calculate the percentage of each and every component associated in the income statement on sales, or assuming sales 100%. So 4,90,000. Did you copy this question? Now calculate the percentage of cost of goods sold, selling expense, general expense, other income, and so on. You calculate the percentage cost of goods sold. 4,90,000. 4,90,000 divided by 7 lakhs. Sales is assumed as 100%. Therefore, divided by sales multiply 100%. It is 70%. It is 70%. Now, similarly, you calculate the percentage of other. Percentage of other. %. General expenses. Other income. Other income 7,000 divided by 7 lakh. It is 0. It is 1%. It is 1%. And 91,000 divided by 7 lakh. 13%. Less other expenses 10,000 divided by 7 lakh. 1.43%. And net income before tax is 81,000 divided by 7 lakh. And income tax 32,400 divided by 7 lakh, 4.63%. Net income after tax is 6.94%. Similarly, you calculate the percentage of each and every component of income statement, other common size statement analysis for 2074. Uh, 6 lakh divided by 6,50,000 divided by 10 lakh. Multiply 100. Hmm. and you calculate the percentage, then analysis is made based on same process, and you are asked here evaluate the company's performance using common size statement analysis. Therefore you evaluate the performance of the company. And gross profit, even the amount of profit increased in the current year 2074, profitability gross profit percentage decrease here, gross profit percentage increase here because of decreasing the cost of goods sold. So it is better symptoms to the company. So profitability will be increased when gross profit increase. Profitability may increase, or net profit can be increased, or net profit margin or percentage or net profit ratio will be increased. And similarly, 10% to 12% uh, selling expense increase due to the sales increase. And similarly, general expenses also increased by 1% here. And and operating income also increased by 2%. So income from operations, income from operation of the business increased by 2%. It is also better. So company has better position in the current year than previous year in comparison to previous year. And other income, there is no change in the other income. It is 1%. It remain constant. And similarly, other expenses slightly increased. Income tax, due to the income increase, net income before tax increase 11.57 percentage to 13.5 percentage. So tax will be increased. It is no new thing, and it is no it is real. And similarly, profitability, real profit or net profit margin or net profit ratio 6.94 to 8.10. So net profit increase in the company. So it is, so overall performance of the company is good due to decreasing in the cost of goods sold. Due to decrease in cost of goods sold, company's profitability position is better. So company has better profitability. Now next, did you finish this one? So lastly, you should analyze, and in the examination you read the questions. Just you don't calculate the percentage only, don't show the common size statement only or common size statement analysis table only. So you must evaluate the overall performance of the company. So here each and every component shows the better symptoms in the symptoms of the company. Therefore overall position, profitability position and financial position of the company is better. Another is 4.25, which is horizontal analysis. Now you write down on the top horizontal analysis. And you are given income statement of comparative income statement of 15, 16 and 17. Now first you copy the amount of 15, 16, 17. Then we assume and we calculate the trend of or percentage values or percentage or trend of different components of the 15, 16, 17 as per this question. Then after we can find out the change in sales, change in the cost of goods sold, change in selling and distribution expense and other expenses. So first of all, you copy these as given in the question. So under horizontal analysis, each and every component is assumed 100%. Did you copy the question? Did you copy the question?
Yes, sir.
You calculate the percentage of 2016 comparing with 2015. So any information or all the components of 2015 are assumed as 100. So 5061 sales is assumed as 100. So what is the percentage of sales of 2016 on 2015? You calculate 5,940 is the amount of sales of 2016 and amount of sales in 2015 is 5,600. Current year's sales divided by last year's. So current year value CY, current year value divided by last year value, then you can find out the percentage. So 5,940 divided by 5,061. Now you calculate the percent. 5,940 is the current year value divided by last year value. Multiply 100. Multiply 100. This is 117.37%. It means increase by 17.37% in sales. What is its effect on the profit that will be seen? Now you calculate the percentage of each and every component of you calculate the percentage of cost of goods sold. It is 1,550. The data are in million. You write down on the top rupees in million. RS rupees in million. Rupees in million. Now, 1,550 divided by 1,400. 1,550 divided by 1,524 divided by 1443 multiply 100, then you get 105.61%. Only cost of goods sold only increased by 5.61 percentage, but sales increased by 17.37 percentage. So the amount of profit will be increased, certainly will be increased. Now next is selling and distribution expenses. 1878 divided by 1682, and it is 11.65 percentage. Similarly, you calculate the percentage of uh, selling expenses. Then after research and development expense, 669 divided by 566, then it is 118.2%. It means 18.2 percentage increase. Next is income from operations. 1370, 1869 in the current year. 1869 divided by 1300, so it is 136.42 percentage. It means 36.42 percentage increase. Similarly, you calculate other income 35, other income 35, and other income is 4. Other income here decrease. Other income is decrease here. So uh, 35 divided by 4 divided by 35. Is it positive or negative value? 4 divided by 35. It is 11%. Only 11% change here. Decrease. Each and every component will be analyzed like this. So here 35, 11.43 percentage decrease. And similarly, income before tax, you calculate, and similarly provision for tax 664 divided by 499, it is 133. So it is increased and it is decreased. Here you write down the bracket and bracket राख्नुलाई यहाँ चाहिँ नभए म टाइपेको छ 11.43 percentage. 11.43% decreased by 11 point, or it is not decrease, it is 11.43 percentage of 35. ठीक है, 11.43 percentage of बेस इयरको कम्पेरिजनमा यो 11% मात्र हो भन्न खोजेको. And similarly, last one, 1209 divided by 906, it is 133% of base year. Base year, it is our next year, it is increase or decrease. Our next year here. And similarly, you calculate for next year. And for next year also, you assume 2015 is base year, and you calculate the percentage of 2017 on the information of values of 2015. 6551 divided by 5061 based on current year divided by 2015, current year divided by 2015. Current year divided by 2015. It means the information of 2017 divided by 2015. 6551 divided by 5061. So 6551 divided by 5000 multiply 100 is 129%. Now you calculate the percentage of each and every component assuming to base year. So, and 18, 19, 20, we calculate the percentage of each and every values, and these percentage can be plotted in the graph. Then we can see the percentage of sales or percentage of cost of goods sold. Each and every component can be plotted in the graph. Then can be seen increase, decrease, fluctuation there. So they are uh, and other income, it is 47, means 134 percentage of the base year. Base year भन्दा तपाईँको 34% धेरै छ भन्नु खोजेको हो. Like this, we calculate the value. Then we evaluate the performance based on the horizontal analysis. Sales increase, gradually increase, and similarly, cost of goods sold slightly increase, and similarly, selling and distribution expenses 11% increase here, 19% increase here. So selling and administrative expense also increase. Another is research and development expense 118 to 30, and huge amount spent here also in the selling research and development expense. Similarly, other income decrease here by 88.57 percentage here, 88.57% decrease here from the base year. So only it is 11.43 percentage of previous year. And in second year 2017, this is increase. It is 30 increased by 34 percentage from the base year 2015. So, and similarly, provision for tax, and when the profit increase, certainly the tax is also increased, no problem, and no different. Net profit after tax is also gradually increasing from the base year. It is increased by 65%, or in comparison to 2015, net profit increased by 65% this year, or net profit of the current year is 65% more than that of 2015. So overall, the company's position is better here, because cost of goods sold is not drastically changed, which is directly proportional to sales, and the amount of sales is a percentage of sales increase, and the profit increases. Therefore, overall performance of the company is better. खर्च ठिकैले बढेको छ, प्रफिट राम्रो ड्रास्टिक चेन्ज छ, सेल्स पनि राम्रोसँग इन्क्रिज छ, बेटर इन्क्रिज इन द सेल्स, बट विथ रेस्पेक्ट टु सेल्स कस्ट अफ गुड्स सोल्ड इज नट इन्क्रिज, सो इट इज द बेटर सिम्टम्स अफ द कम्पनी, देयरफोर कम्पनी हेज बेटर पर्फर्मेन्स भनेर यति गरेर छोड्ने होइन, तल एनालाइसिस पनि लेख्नुपर्छ नि फेरि है, सोधेको नि हुन्छ, इभ्यालुएट द कम्पनीज पर्फर्मेन्स युजिङ होरिजेन्टल एनालाइसिस। टिल नाउ इट इज नट आस्क, इट इज नो मोर डिफिकल्ट, यो गाह्रो चिज भएन होइन, तपाईँलाई अब सानो सोध्न सकिन्छ नि त, कमन साइज स्टेटमेन्ट सोधेर अनि तपाईँलाई रेसियो एनालाइसिस जोड दिन सक्छ यसैमा चाहिँ होइन, क्यालकुलेट गर्ने रेसियो क्यालकुलेट गरेर अनि त्यसपछि तपाईँलाई एनालाइसिस पनि त्यसको पनि सोध्न सक्छ। इन सच कन्डिसन यु सुड एक्सप्लेन द you should interpret the result calculated based on horizontal analysis or vertical analysis. Then you should calculate the different ratios and analysis based on ratio that will be discussed in the ratio analysis. Analysis part चाहिँ हामी रेसियोमा डिस्कस गर्छौँ। अब यसको एनालाइसिस चाहिँ भने बेटर पर्फर्मेन्स, वर्स पर्फर्मेन्स, केलाई हेर्नु पर्यो, सेल्स इन्क्रिज, cost of goods sold is not increase with respect to with proportion to sales, therefore it shows the better symptoms in the company, therefore the profitability position is improved in comparison to 2015 भनेर सानो एउटा प्याराग्राफ एक्सप्लेन गर्नु पर्यो, यही फिगरलाई हेरेर आफ्नो तरिकाले एनालाइसिस गर्नु पर्यो। अब तपाईँलाई इफ यु आर गिभन फर डाटा अफ 15, 16, 17, 18, 19, 2015 is base year, divide by the information of 2015, value of 2015 to every year, value of every year, हरेको त्यसरी नै पर्सेन्ट निकाल्नु पर्यो। यो भयो तपाईँको horizontal analysis. Now next topic is ratio analysis. Now ratio analysis. Before starting the ratio, did you finish this one? Did you finish?
Yes, sir.
Now ratio analysis. Now what is before starting the ratio analysis, what is ratio? पहिला तपाईलाई रेशियो, what is ratio? What is ratio? Ratio is simply the comparison or relationship between two variables, comparison between two figures which are expressed in numerator and denominator form, So ratio is mathematical relationship between two variables expressed in numerator and denominator, so that two values of or two figures or values of two variables are comparable to each other. Now ratio analysis is the quantitative methods which use the accounting variables or accounting figure expressed or presented in the financial statement. Therefore ratio analysis is one of the financial statement which is used. Ratio analysis is the one of the tools or technique of financial statement analysis. So it is used to measure the liquidity position, leverage position, or solvency position of the company, and operating and financial result of the company. So amount of profit is not better to explain to interpret the result. Amount of profit does not show the symptoms for better profitability position, but percentage of a ratio should be calculated with respect calculated or profit with respect to different variables. Then that can be compared with previous years, or that can be compared with the industry average, that can be compared with other different competitors to find out the real profitability position. Similarly, to study the better financial position of the company, or to study the financial position of the company, whether it has better or worse, which are presented are based on the financial statement, which are presented in the financial statement are based on financial statement. So ratio analysis is used to show the relationship between two variables which are presented in the financial statements. which shows the relationship or evaluates the relationship among the financial statement items are presented in the financial statements. Ratio analysis focuses on mainly focuses only on three components: liquidity, profitability, and solvency position of the company. Company has better or worse liquidity or profitability and solvency position, that will be measured, analyzed, and interpreted based on the information or figure presented in the financial statement. Now, there are different types of ratios, and basically we focused four types of ratio: liquidity ratio to measure the liquidity position. Its answer or the ratio, liquidity ratio, is calculated in the pure ratio form. And you must know, and you already studied in the plus two and bachelor level, ratio can be expressed in the pure three forms, three ways. The value of ratio can be expressed in three forms. They are pure ratio form, is to 1. When we divide the numerator by denominator, then we get the index value, and that value is presented as is to 1 in the pure ratio form. And sometimes some of the ratio can be expressed in the form of times or rate, like 4 times, 5 times, 10 times, 20 times. And some of the ratios are in the expressed in the percentage. Liquidity ratio and leverage ratio are calculated in pure ratio form, presented in the pure ratio form, that is to 1 at the end. After calculating the value, we put is to 1. Then we compare out of 1 what is the association, what is the value of liquidity ratio. And turnover ratio is the ratio of different variables, relationship of different variables comparing with sales. And when you compare different values of different financial statement or different components of financial statement in comparison to sales, this is turnover ratio. Another is profitability ratio, ratio of different values, different figures presented in the financial statement comparing with profit, that is profitability ratio. So liquidity ratio is calculated to measure the liquidity, short-term liability payment capacity of the company, or current liabilities and current assets position, or current can company make the payment of its current liability by its current assets or not, that will be judged by liquidity ratio. Similarly, leverage ratio measures the long-term liability payment capacity position of the business. So it helps to show the solvency position of the company. Can it be can the company or is the company solvent or insolvent? Can it maintain its long-term liability by its long-term capital or not? Can it make the payment of long-term liability by its long-term capital or not? Or the association, the relation of long-term loan and long-term capital is leverage ratio. Another is turnover, and turnover ratio is calculated to know the amount of credit sales with respect to different variables, or amount of sales with respect to different variables. And profitability ratio measures the profitability position of the company. And before starting the ratios, calculation of different ratios, we must know the basic concept and basic things that you already studied in the plus two level, basically in the plus two level and bachelor level. Working capital working capital is the difference between total current assets and total current liabilities. And another is equity, and we use the term equity, that is stockholders equity, or that is owners equity, or that is shareholders fund. Now, shareholders on is calculated or shareholders equity is calculated. First of all, you must know what is shareholders equity. What is equity? I had already told you in the financial statement, corporate financial reporting. Shareholders equity is simply the right of the shareholders in the company. When shareholder contributes the capital, either equity shareholders or preference shareholder, or in terms of equity capital and preference capital or preferred stock, they on both of the capital, the shareholders have right to claim either equity capital or preference capital. Shareholders have right to claim that is shareholders equity, and that is contributed capital. And there are some other amount of capital, they are called earned capital, which is reserve and surplus. Some amount of profit is distributed to the shareholder. After distribution to the shareholder as dividend, some amount of profit remain in the company in the form of reserve and retained earning or surplus. Reserve and surplus and retained earning. And beside this, some amount of expenses on that profit, reserve and surplus, that is the remaining amount of profit. On that profit, the owners have also right. So that is also the shareholders equity, owners equity. So share capital, equity capital, preference capital fall under the share capital heading if you learn in the plus 2 and bachelor level under the shareholders equity. And uh, in um, in our class in second chapter also we discuss equity capital, preference capital, or equity uh, common stock and preferred stock. Both are the component of the shareholders equity that we already discussed. And beside this, reserve and surplus also, reserve, any amount of reserve and retained earnings, they both are under the shareholders equity. So you already prepare the financial statement and you know what are the component of shareholders equity. Beside this, if there are any unamortized expense like preliminary expense, underwriting commission, discount on issue of share, or accumulated loss, instead of surplus there may be sometime accumulated loss. That loss will be deducted on that. Shareholders have responsibility to fulfill, to compensate. Therefore, shareholders equity or stockholders equity can be calculated as equity capital plus preference capital plus reserves plus retained earning uh, and minus unamortized expense or preliminary expense. They fall under the miscellaneous expense heading that we studied in plus 2 and bachelor level under miscellaneous expense heading. Preliminary expense, discount on share, PL account loss or debit balance, and underwriting commission. And next one is total capital. Another point is total capital or capital employed. You must know total capital and or total capital, how to calculate. Or total capital is also called capital employed. So shareholders equity or stockholders equity plus long-term debt. Stockholders equity plus long-term debt. And what is long-term debt? LTD. Long-term debt, how do we calculate long-term debt? Long-term debt is liability for more than 1 year maturity, having more than 1 year maturity period, like debenture, bond, mortgage loan, bank loan. And what are given? You add this, and this is long-term debt. And long-term debt plus shareholders equity, which you calculated from B number, that will be added. And sum of shareholders equity and long-term debt is the total capital or capital employed. And another is return. Return is, in simple sense, return is the net profit after tax, or the profit earned by company after payment of tax is called return. And if you are shareholders and you have contributed capital in the company, you are expecting the return as net profit. And if you have if you have lent, you have given the loan to the company. If you have given loan to the company and you do not get the profit from the company, so what is your return at that time? Interest. So when you are calculating the return of shareholders, that is net profit after tax. When you are calculating the return of loan provider, that is interest. So what is the return of total capital? Shareholders capital employed or total capital. Capital employed consists of shareholders' equity and long-term debt, and the return of shareholders is net profit, and the return of capital loan provider long-term loan is interest. So, what is the return of total capital or capital employed? Uh, Net profit after tax and interest. So, these are the basic rules and principle or formula for the calculation, and that will be frequently used and essential in the ratio analysis. Now we are going to discuss the types of ratio. The first is liquidity ratio. I had already told you its answer should be calculated in leverage ratio and liquidity ratio. Their answers, their values are calculated and expressed in the pure ratio form is 2:1. Another is turnover ratio. Its answer value is expressed in times, 4 times, 5 times, 10 times, like this. And last one is profitability ratio, and their values, their ratios of profitability ratios are calculated and expressed in the percentage. Now, first we are going to discuss liquidity ratio. Now, liquidity ratio consists of two ratios, current ratios and liquid ratio or acid test ratio or quick ratio. Current ratio and quick ratio are the two ratios that fall under the liquidity ratio. Quick ratio. Quick ratio is the ratio between current assets and current liabilities, or current ratio is the relationship between current assets and current liabilities. So, what is the formula for the calculation of current ratio? Here I have highlighted by blue color and red color. First factor you have seen current ratio between current assets and current liabilities. So first factor is total current assets and second factor is total current liabilities. So you are calculating ratio of first factor and second factor. So you write down in numerator first factor and denominator second factor. Another is therefore total current assets divided by total current liability is the formula for the calculation of current ratio. So current ratio measures the liquidity position of the company. Can a company make the payment of current liabilities by its current asset or not? That will be judged. Another is quick ratio. Quick ratio is simply the relationship or ratio between quick assets and the current liabilities. So again, here I have highlighted by blue color and red color. Blue color is first factor and red color is second factor. So first factor is in numerator, second factor is in denominator for the for derivation of the formula for quick ratio. So what is quick asset, that we need to learn. So where quick assets are those assets which can be quickly converted into cash, converted into cash within the specified date, with a specified date. So, stock and prepared closing stock or ending inventory and the prepared expenses are not quick assets, even they are current assets, because they do not have the specific time period. They do not have a specific date, and when you have closing stock and you can't convert into cash immediately, and within a year it will be converted or process or converted into cash by selling. But prepared expense and closing stock cannot be easily converted into cash whenever required. Therefore, total current assets include all these: cash, bank balance, receivables, accrued incomes, stock, prepaid, everything. And when you have already calculated total current assets, from total current assets, when you deduct the prepaid and closing stock, the remaining current assets are quick assets and they can be converted quickly into cash. So they are called liquid assets too. In another word, when you haven't calculated total current assets, that in such condition, it is not possible to deduct prepaid and closing stock from the total current asset. In such condition, you can calculate quick assets as sum of all current assets except inventory and prepaid. So exclude the inventory and prepaid. Inventory and prepaid line no bagi current assets has only. Some of the remaining current assets except stock and prepaid are quick assets. In this way, we calculate the quick assets. That means quick assets includes cash plus debtor plus account receivable plus bills receivable plus bank plus accrued income, marketable securities, not inventory and prepaid. Not inventory and prepaid. So first way or last or second, which you can use any formula to calculate the quick assets. Now the liquidity ratio, I have just now told you on the formula, how to make the formula for the calculation of quick ratio. Quick ratio measures the short-term liability, current liability, payment capacity by its current asset. Can the company make the payment of its current liability by current assets or not? That is measured. So here you have seen first factor current assets and second factor current liability. First factor is in numerator, that is current assets. Second factor is current liability, that is in denominator. Similarly, in quick ratio, first factor is quick assets, second factor is current liability. First factor quick assets should be in numerator, second factor current liability should be in denominator. By this concept, we are going to derive the formula. Current ratio and the quick ratio are the two ratios under calculated under the liquidity ratio. And current ratio is the ratio of current assets and current liability. So first factor is in numerator and second factor is in denominator. Similarly, quick ratio, quick assets divided by current liability. Quick asset is first factor and current liability is second factor. That I have shown you here. First factor is quick assets and second factor is current liability. So first factor is in numerator, second factor should be in denominator. So another is, then after we discuss exercise, and quick asset is calculated as, quick asset is calculated as current assets minus or total current assets minus stock minus prepaid. I have already told you this one. Now next is leverage ratio, and leverage ratio measures the long-term liability payment capacity of the company. Can a company make the payment of long-term liability by its capital or not? Long-term capital or not? Or what is the position of long-term? What is the association of composition of long-term liability on total capital or shareholders fund? So the first is debt equity ratio or debt to shareholders equity ratio. Debt to equity ratio or debt to shareholders equity ratio. Shareholders equity ratio. Shareholders equity ratio. And debt to shareholders equity ratio. Ratio is the ratio, or is debt equity ratio is the relationship between total long-term liability and total shareholders equity. And you have also seen here first and second factor. I have clearly mentioned by blue color and red color. And first factor is in blue color and second factor is in red color. And first factor, debt equity ratio. Debt is long-term debt, equity is shareholders equity. So first factor, debt is in numerator, long-term liability, a long-term debt in numerator, and divide by shareholders equity. And another, it consists of two ratios also under leverage ratio: debt to total capital ratio or debt to capital employed ratio. Debt to total capital ratio measures the long-term liability portion or position or composition of long-term liabilities out of total capital. So debt to total capital ratio is the relationship between total long-term liability and total capital. So it is clear, debt to total capital. Debt is long-term debt. Total capital is capital employed, or total capital is second factor. So long-term liability is in numerator, total capital in denominator. So turnover and profitability ratio that we will discuss in next class, and we do practice from the exercise relating to liquidity and leverage ratio from the book, page number 141. Page number 141. So leverage ratio, the formula of leverage ratio, then we do practice from the exercise. Debt equity ratio, debt, long-term debt in numerator, and equity means shareholders equity, that is second factor in the denominator. Similarly, debt to total capital ratio, debt is long-term debt, which is first factor in numerator, capital or capital employed, total capital or capital employed, whatever, that is in denominator, that is second factor. So debt equity ratio and debt to total capital or debt to capital ratio are the two ratios under the leverage ratio. So you write down these two formula. Then we discuss turnover and profitability in next class. And we do exercise from page number 141 now. So all of you copy debt equity ratio and debt to capital ratio. Debt equity ratio, debt long-term debt divided by shareholders equity. And another is B number, debt to capital ratio. Debt, first factor debt to capital ratio. Second factor, debt is long-term debt, which is in numerator. Capital is second factor, which is in denominator. Did you write?
कति नम्बरको क्वेसन हेर्नु सर?
One बाटै गरेँ. Did you write this two formula, debt equity ratio, debt to capital, and similarly
Yes, sir.
liquidity ratio, current ratio, and quick ratio?
Quick ratio.
Current ratio, total current assets divided by current liabilities, and quick ratio, total quick assets divided by current liabilities. Did you write?
Total current liability.
current assets and current liability. Relation of current assets, current liability. Current assets in first factor is in numerator. Current liability is second factor in denominator.
Quick assets money C.
Quick assets, total current assets minus stock minus prepaid. Total current assets include stock and prepaid. Therefore, to find out quick, stock and prepaid should be deducted from the total current assets. Page number 141, 4.1 question. You are given the balance sheet. So you need to calculate liquidity ratio, which falls current ratio and quick ratio both.
Liquidity ratio निकाल्ने.
Yes, liquidity ratio consists of two ratios. So you now you calculate page number 141, question number 4.1. You have seen liquidity ratio, which consists of current ratio and quick ratio. Now current ratio equals to total current assets divided by total current liabilities. Now total current assets here, it is already given total current assets 50,000. Have you seen? Total current asset is 50,000. 50,000 divided by total current liabilities 20,000. Now you divide, it is 2.5 is to 1. 2.5 is to 1. 5 is to 1. Now next is quick ratio. Quick ratio includes quick ratio is the ratio of quick assets and current liabilities. So total quick assets in numerator divided by total current liabilities. Total current liability is 20,000. That is same 20,000. Now quick assets. Quick assets, total current assets minus stock minus prepaid. Total current assets which we already calculated. This is given in the question, not calculated. 50,000 minus stock minus prepaid. Stock means inventory given here in this question, 12,000 minus prepaid not given, 0. So it is 38,000. 38,000. It is 38,000. Or in another word, what is quick asset? What is the concept? What is the meaning of quick asset? Those current assets which can be converted into cash except stock and prepaid. So don't add the stock and prepaid out of current assets given. That is quick assets. So in this example, except stock and prepaid, what are the current assets remain there? What are the current assets remain except stock and prepaid? Debtor and cash. Is it or not? Debtor and cash. Now you take the sum. How much is the value? Debtor is 8,000 plus 30,000 is cash. So how much is total? 38,000. In this way, you can calculate quick assets. excluding stock and prepared other current sum of other current assets, remaining current asset is quick asset, amount of quick asset. So both process not necessary to do so. Just I am showing you how to calculate quick asset and what is the meaning of quick assets. So you divide 38,000 quick assets by 20,000 current liability. It is 1.9 is to 1. 1.9 is to 1. Did you calculate?
Bye, sir. Bye.
Now question number 2. The required is debt equity ratio and debt to capital ratio. Debt equity ratio under which falls under the leverage ratio. Debt equity ratio, debt equity ratio. Debt equity ratio or leverage ratio, they are under the leverage ratio. Page number 142, problem 4.2. Now, first one is debt equity ratio. Debt equity ratio is calculated as debt equity ratio, long-term debt divided by shareholders equity. Long-term debt divided by shareholders equity. First factor debt, long-term debt, and second factor shareholders equity in the denominator. And long-term debt, you are given 2, which falls under the long-term debt category of the balance sheet. So in working note, you calculate long-term debt. Long-term debt equals to long-term debt equals to long-term debts are given. Long-term loan, it's 1 lakh rupees, and 8% debenture given 80,000 rupees. 1 lakh plus 8 plus 80,000. It is 1 lakh 80,000. 1 lakh 80,000. Objective. Working note. Long-term debt equals to 1 lakh plus 80,000. 1 lakh 80,000. So you substitute the value 1 lakh 80,000 in the numerator and divide by shareholders equity. Now you calculate shareholders equity. Long-term debt is 1 lakh 80,000 divided by shareholders equity. How you calculate shareholders equity? Shareholders equity equals to equity capital. The examination you write down directly the value, not necessary to write as equity capital plus preference like this, not necessary. Preference capital plus reserve, RESERVE, reserve. Similarly, PL account, if you are given PL account, it is the retained earning. PL account credit. If you are given PL account debit, it is accumulated loss. So that should be compensated by the shareholder. So that should be deducted. So let's go further. Plus PL account the account, long-term loan already finished, debenture already finished, bank overdraft, creditor, outstanding are current liabilities. That's all. So take the sum. Equity capital 1,20,000 plus preference 80,000 plus reserve 26,000 plus 24,000 PL account minus unamortized expense 0. You keep it in mind, not necessary, but unamortized expense is 0. Not given here. Not given here.
2,50,000.
Plus 2,50,000. Now divide by 2,50,000 in the formula 2,50,000 equals to, it is ratio. Its answer should be calculated in pure ratio form. Better to calculate, but can be expressed in percentage, no problem. But technically, conceptually, it should be calculated in pure ratio form. Pure ratio form is to 1. Divide गर्नु
0.72.
0.72 is to 1. Or it means 72%, no problem. Out of 1, 72 means 72, or 0.72 means it is 72% out of 100. Now next is debt. Sorry,
72% भनेको लङ टर्म डेट गर्न त्यति चाहिन्छ भने हो
long-term debt 72% is long-term debt out of shareholders equity. So long-term debt 72% of total shareholders equity is sufficient to cover the long-term loan or for the payment of long-term loan. So 2,50,000 is the shareholders equity, 1,80,000 is the 80,000 is the long-term loan. So 1,80,000 loan can be easily paid by 2,50,000 because 0.72, suppose it is 72 paisa. 72 paisa of long-term loan that can be paid from the shareholders equity by 1 rupee. So it is sufficient, but 72% is quite large amount of loan. 72% is quite a huge amount of long-term loan in comparison to shareholders equity. भनेको धेरै पर्सेन्ट चाहिँ तपाईँको यहाँ इन्ट्रेस्ट धेरै पे गर्नुपर्ने भयो नि त. सो फ्रम द कम्पनीज पोइन्ट अफ भ्यू इट इज बेटर because huge amount of long-term loan is composed. Therefore, shareholders do not get the better profit. But from shareholders' point of view, it is better. It is not better because 72% loan is used in the capital formation. So huge amount of interest should be paid by the company so that their profit decreases. This is 1,80,000 rupees loan, long-term loan that can be paid by 2,50,000 shareholders equity. So it is sufficient. It is sufficient. Company's leverage position is good, but it's not best because a huge amount of long-term loan is used in the capital formation. And 2,50,000 by 2,50,000 or 72% of long-term loan is too high for the company. When in case failure in the business, long-term loan 72% cannot be paid. And while granting the loan by bank and financial institution, they certainly evaluate the debt equity position, and 72% is huge amount. अब त्यसमा अलिकति थप्यो उनीहरूले लोन दिनेले थप्यो भने के हुन्छ? Certainly the long-term loan will be, percentage of long-term loan will be increased. In such condition, bank and financial institution do not provide the loan. So because it does not show the better liquidity leverage position. कुन पर्सपेक्टिभले भन्दा कम्पनीज पर्सपेक्टिभले हेर्दा चाहिँ धेरै लोन युज गरेको छ, शेयरहोल्डर्सहरूलाई को प्रॉफिट घट्ने भयो भनेको net profit decreases. Net profit decreases means from tax point of view, a lower amount of tax is paid by the company. company lower amount of tax, there is a tax saving only one, but tax saving one and lower amount of tax will be paid. So ultimately it affects to the dividend or profitability position of the company and affects to the dividend effect गर्छ भनेर भन्नुभयो अरे 72% of 72% of total shareholders equity is long term loan भनेको it is huge percentage 72% भनेर त धेरै ठुलो अमाउन्ट भयो लोनको पर्सेन्टेज धेरै भनेको नेक्स्ट बी नम्बर B number is debt to capital ratio or total capital ratio. Debt to total capital ratio or debt to capital ratio. Now, debt means long-term debt. Divided by capital means total capital. First factor debt is in numerator. Second factor capital, it is in denominator. That is called total capital. Long-term debt we already calculated 1,80,000 divided by total capital. Total capital equals to, how do we calculate total capital? Shareholders equity plus long-term debt. Shareholders equity is shareholders contribution, long-term contribution of the shareholders. Long-term debt is total long-term contribution of lenders. So how much is the total capital formed? Shareholders equity plus long-term debt. Shareholders equity is 2,50,000 we calculated, plus long-term debt is given 80,000 plus to 3,30,000. In denominator 3,30,000. It is 0.
Sir, long-term debt mistake bhaina ra
1,80,000. 1,80,000. So it is 4,30,000. 4,30,000. 0.418 is to 1. Okay, in this way you can so in question number 3 it's turnover ratio. In next class we'll discuss the turnover ratio. Okay, in next class we discuss turnover and profitability, then after only other exercise we can do and we discuss. Okay, that's all for today. Time is finished. Now in next class we discuss about turnover and profitability. That's all for today. See you. Bye bye.
Bye, sir.
Bye bye.
Thank you, sir.
Bye bye.